partners at DIFC FinTech Hive. First, I would like to take a minute and welcome our 2020 cohort, the 17 fintech startups that joined the DIFC FinTech Hive Accelerator program, including DX Compliance, Receipt, FOMO Pay, Synopsis, Nestor, Fligo, Safe, Infer, Voucher, Expanse AI, First Hive Tech, Tarabut Gateway, OK High, Trust Stamp, Reem Takaful Tech, Asante Financial Services Group, and Algante. This is the group that joined our cohort this year, and they are set for an amazing journey ahead of them. I wanted to welcome them through our webinar Wednesday today. Today's panel, we will be discussing the different perspectives on what it takes for a fintech to succeed. The session will kick off with a consultant's perspective presented by Mark Stanley, Director in the Financial Services Industry with PwC Middle East. And then will be followed by an entrepreneur's perspective by Habib Khan, Director of Content from Penumbra. A UK Fintech perspective by Rory Martin-Smith, a Scale Program Manager at PwC, and Tom Hoskins, Partner and Co-Founder at Growth Builders. And finally, a banker's perspective by Sameer Poonja, SVP and Group Head of Innovation at Gulf International Bank. The session will be looking at few topics, such as what fintechs need to think about when seeking growth opportunities, how to be successful and identify gaps in the market, what innovation means for fintech, why banks fail, why fintechs are needed to help. And finally, some lessons learned from the FS Scale program in the UK. I hope you benefit from the conversation. If you have any questions, please write them in the questions box and they will be addressed at the end of the session. And now, Mark, I hand it over to you.
Thank you, Raja. Let me just share my screen. And Raja, just the final presenter is Ali Khan, who will be concluding at the end of the presentation, and then obviously coordinating the Q&A towards the end as well. But Raja, firstly, thank you very much to you and the DIFC for this opportunity, and thank you to obviously all the speakers that have joined us here today. And I think we've got a really nice mix of both industry and consulting to hopefully give you a really interesting perspective on what we're seeing in the market and things that fintech should perhaps be looking out for when they think about partnerships as they look to grow their businesses here in the MENA market. We don't have a huge amount of time, so we will move quite quickly through the content. To kick us off, myself, just a quick quote. If you've always done it this way, then it is probably wrong. So I think this is an amazing quote for the financial services space. The number of times I engage with a particular client on a particular issue and be told that, you know, this is something that is the way that we've always operated, and so it's difficult to have it changed is countless. And quite often they blame regulators, but I've never met a regulator that wasn't open to having a discussion around how you can do certain things, so long as you're protecting the market and protecting end users. So I thought, you know, this is a great little piece, and obviously this is at the heart of what fintech is really starting to do as well in the financial services space. So first thing I'll just briefly cover off is from the corporate and then startups view of the world, what are a set of motivations and then hurdles to a successful partnership? Some data to begin with. So on the behalf of corporations, and this was a survey conducted in Europe recently, but main motivations for partnering with startups. Obviously the main things that came out of this are exploring new technologies or business models, and obviously gaining insights into nascent industry trends. So that obviously fully aligns with what a fintech is meant to do. It applies new technologies and disrupts business models in a way to create either new revenue opportunity or to tap into existing revenue pools in a slightly different way. So that makes sense in terms of what corporations are looking to get out of a fintech partnership. What are some of the critical success factors that they point to? So first one's around a strategic fit. So does the fintech align with the strategy of my organization, a bank? Yes, that makes sense as well. You've got to make sure that you're helping them deliver on their strategy. There's then something on startup quality, which again makes sense. A startup's got to be of a quality. There's got to be perhaps market product fit. They've got a level of maturity in their technology as well to make sure that it can be deployed in their architecture and be deployed successfully. And then there's some stuff around it, shared mission between the corporate and the fintech. And then there's a couple of pieces on internal support and bandwidth. So can the actual bank support the fintech as it enters into a partnership and then executes as it moves through? Interesting thing here for me is that almost all of these aren't actually controlled by or can't be influenced by a fintech. So for that reason, again, you've got to be very careful with the partnerships that you do end up selecting. If we flip it then quickly and just look into what a startup's motivations are for seeking out a partnership, again, I think these all make sense, right? Visibility, publicity, access to new markets, that's what banks have, right? They have access to customers. A fintech's looking to be able to quickly access those customers. And then there's some stuff around market knowledge, understanding what the way a particular market operates or the way a particular bank operates in order to make sure that the fintech is able to support an organization in its wider goals. On the flip side, what are the issues that perhaps prevent partnering with corporates? So first one I think really does make sense. Speed, slow decision making. Banks are notorious for taking a long time to make decisions and going through multiple layers of approval, whereas a fintech needs to move fast. Coordination, making sure that you've got a single point of contact and it doesn't keep changing. Things around culture, and then obviously the really tough bit around negotiation with procurement around contracts and that type of thing. So I think all of these really make sense, and I'm sure most of the fintechs here today and people that you've spoken to can definitely support these statements that are being made here as well. So how about how to collaborate? So there's a few different models that we've observed both here and then in global markets, and these obviously go from the more connected to perhaps the least connected. But the first type is obviously investments or equity participation. That can be in the form of either venture capital to get partial control or full control through a particular M&A. Commercial arrangements, everything from information exchange, shared learnings, right the way through perhaps setting up a particular JV where you then have joint operations of a separate legal entity that you deliver or you take to market together. And then the co-creation component where incubators are either collaborative, you have an incubator where you are then collaboratively working together, or perhaps some organizations, banks will set up an excubator where they're doing their own skunk works and actually trying to work through and develop new propositions themselves. I think the key thing for a fintech to think about is these different partnership models then have a direct impact on your degree of integration or autonomy from the partner that you're actually engaging with. So some of the key considerations here would be, what is your strategy? When do you, or are you even seeking an exit opportunity? What is the size of the opportunity with the particular bank? And what kind of sacrifices are perhaps you willing to make in terms of the control of your organization? And then finally, as everybody knows with fintechs, necessity and urgency. How are you placed in terms of your VC and your funding? How far can you go? Is this something that you really need to take on? But these are just kind of a playback of different models that we've seen, but something that obviously fintechs need to think very carefully about. So what should you look for in a successful partnership? We wanted to, first of all, I like this quote because I don't think really I think it's true, but it's based on the maturity of a particular organization. And innovation departments can be good and they can be bad. And I will give a little bit of an example why through a case study that we've got. So ING has been a very successful example of how to incubate and work alongside and partner with fintechs. A couple of bits of information on their program. They can get to a POC within 4 weeks. And they can get to a decision to invest up to $30 million within 2 weeks. And there's some examples of some of the organizations they've invested there in here on the left. And I think what's been really successful about the ING model is what they call the 3 Ps. And I just want to quickly run you through those 3 Ps. So the first one is around what they call principles. But this basically says that business always has to be in the lead. And that was kind of referring back to the quote earlier. If you've got an innovation team that isn't engaged entirely with business, and you don't see that there is a senior business sponsor for your partnership that you're thinking about taking on, you will really struggle. So that's the first thing that you need to think about. Second is around priority. Has the bank identified and clearly articulated that your area of focus is of a strategic priority for the bank? Because if it isn't a priority for the organization, for the bank, they're probably using you to show off as a flashy new proposition without really aligning to the strategic objectives of a particular bank. The third one is about process. So do they have a well-defined decision-making process? And this came a little earlier to the question around things like procurement. If you arrive in the procurement department talking about contracting and they start to treat you like an IBM or a significant large-scale vendor, you know there's probably a problem. And eventually it's going to waste a huge amount of your resources and probably prevent you from proceeding. And the fourth one then finally is around performance. So you should be able to set a set of KPIs together with your partnership, but those KPIs should also have some expectations of the bank themselves. And those can then be, they take the emotion out of a particular engagement. They make sure that there are things that can be tangibly measured and looked at. So those for us are things that you should be looking for as a particular fintech. If you don't see all three of these in a particular bank when you're talking about a partnership model, there's probably something wrong and you've got to be a little bit careful. The last thing that we'd say is that I like this quote because I think it's really true. It's all about focus. Focus on your product, on your MVP, on what you're going to take to market, but also focus on the partnerships that you're actually going to participate in and the people that you're going to engage with. So that's just basically a quick run through some initial ideas that we have. We're going to take some questions at the end, and I'll hand over to Habib now to run through his section as well. Thank you. Habib, you there?
Yeah.
Fantastic.
Thank you, Mark. Hope everybody can see my screen. If the internet becomes a little unstable, just wait 30 seconds. We should be fine. All right. So thank you for having me. Humbled and excited to be here. Quick intro. I've worked with fintechs in 5 countries to raise close to 18 million USD in Series A and Series B funding, right? So like all of you, I'm learning constantly. And one of my greatest learnings came from when I worked with a GCC FinTech when they were still on paper, and I stayed with them on their journey until they raised a Series B round at a $100 million valuation, right? I still remember building that pitch deck. It was a lot of fun. So I've been in the trenches with the fintechs in the GCC, right? And we've won together, we've lost together. And I wanted to share a bit of what I've learned. So I'm going to go from a 300,000 feet level to the ground level in this presentation quickly and just mention a few key principles that I think are important to keep in mind as you guys go on your journey, right? And it will be a journey, and there'll be some interesting ups and downs, but hopefully these principles can give you some perspective, right? So I've titled this presentation FinTech Next. So a new disruptive age is upon us that takes no prisoners. I know everybody says that, but these numbers that back it up are quite astonishing. So the average tenure of companies has narrowed from 35 years in 1965 down to 14 years by 2026, right? Nearly half the companies that are top 500 companies right now, they won't be in 10 years. In the last 4 years, $16 trillion has been spent on mergers and acquisitions. My definition is the strong are eating the weak. Now, most global executives of billion-dollar plus firms agree they need to transform to survive, but only 15% are confident they can do it. I mean, think about it. This is astonishing. These are powerful, rich companies that do not lack for resources. They're not confident they can transform. Basically, guys, girls, innovation is failing. Right? So companies have never had more data about their customers thanks to big data and analytics. They've never had more tools and resources. The R&D spend for the top 1,000 publicly listed companies is over $680 billion. Companies have got making products down to an exact science. They've got Six Sigma, they've got concepts, tools, platforms, everything, right? They have access to the greatest consultants in the world, right? They can pay a product designer $1 million a year. But innovation for growth is basically miss, right? 94% of global executives are unsatisfied with their innovation performance. What's going on, right? Then this applies to incumbents, all incumbents, and banks are incumbents, right? So here's my favorite quote when talking about digital transformation and efforts that are done accordingly. We're lost, but we're making good time. The principle that I want to leave you with here is that companies are currently, and banks are throwing money at protecting the top line and the bottom line using automation and tech. But this often gives an illusion of progress. And none of this will save anybody from disruption, least of all the banks. This is because, and here's the key principle, disruption starts with unhappy customers, not technology. Okay, I can't stress this enough. Disruption starts with unhappy customers. It's not about tech, right? So here's a digital banking disruption scorecard that I've come up with after my experiences with fintechs, right? And these are fintechs who have been successful in disrupting banks. So if any of this applies to banks, trouble is closer than they think. And I remember presenting this to the central bank governor in my country and his entire leadership team, right? So we did a training for them. And I remember the head of digital for the largest bank was there, and he took a picture. And I'm like, why are you taking this picture? And he's like, you know what? I'm going to send this to the bank president, because the fact of the matter is each one of these points applies to us. And this is the biggest bank in the country, 1,300 branches, God knows how much in deposits, right? So let's look at the first point. If banks are leaving customers unserved because of lower gross margins, they can be disrupted. What does that mean? Look, in every country, if the customer acquisition cost does not justify you going after a certain type of customer, you will not, right? And quite often that means the poor or the ones right above the bottom of the pyramid are left out. In many cases, this could even be migrant workers, right? So what happens is that a fintech figures out how to serve them with lower customer acquisition costs and customer delight, and then they move up the value chain and start attacking the profit centers of banks. And because they are nimbler, because they're leaner, it's impossible to fight them with normal means, simply because they figured out, they've cracked the code on how to acquire customers cheaply. So here's another point. If your customer employees are mostly millennials, Gen Z, or digital natives, you can get disrupted. And I almost never hear this point when we have discussion digital transformation, and it is such a key point, right? I was with a client. It was a $1.5 billion company, and I was sitting with the president, and I said, I remember his name is Riaz. I said, Riaz, you're going to get disrupted. And he's like, no, I'm not. I'm sitting on $700 million in cash. I've got a great leadership team. I've got a plan in place. The board's on board. We're good to go. I said, here is your attrition rate of your top university graduates in your company. And I showed him the number. I pulled it from HR. It was 60%. I said, the best of the best do not want to work with you. 60% of them leave in the first year, probably more in the second year. How are you going to have a middle management in 5 years? You cannot underestimate how important this is. And when you look at banks, there's a civil war going on inside them. SEVP level and below, they get digital. They want to do things. Above that, there's this stasis, right? Things are done the old-fashioned way. You've gotten addicted to retail banking. So it's very important to understand that employee engagement and to understand your customers, especially in the youthful nations that are in the GCC, that if they're millennials or Gen Z, you will get disrupted even if you have everything right, because their journeys are chaotic, they're unpredictable. You have to know them, you have to think like them. That lack of empathy, it can be critical, both inside and outside banks. So if your revenues come from knowledge-based processes or are reliant on key knowledge-based processes, you can get disrupted. So what does this mean? Look, let's take trade finance, for example. Quite often it's based on relationships with correspondent banks. Quite often it's based on relationships with companies. Some medium-sized companies would not get trade finance, but they do because you know them. So this is a classic sort of case that can get disrupted by a smart fintech, right? There's $2.5 trillion of trade finance gap by 2025, right? Most SMB trade finance requests are rejected. This is a classic case of a fintech to figure this out and to disrupt. And probably we're looking at the largest value add to economic generation within the financial services industry if you figure this out. Similarly, if your core offer is commoditized, startups can figure out how to innovatively disrupt it by delighting customers and by controlling how the distribution is classically done, right? So look at the savings accounts, look at the checking accounts, look at the rewards on loyalty programs. How different are they bank to bank, right? Not that different. So this is a great area for fintechs to address and for banks to be mindful of, right? This next point is very, very critical. If your R&D focuses on how to make products better, more profitable, and more differentiated from your competitors, and not an intentional analysis of customers, you will lose. Intentional analysis, or why people do what they do, it's constantly changing, especially with younger customers, especially with mobile first customers. I mean, if you think Gen Z is bad, wait till you see Gen Alpha, which is around 12 years old right now, right? Their brains are rewired different. So when you say that, okay, you know, Al Raji in Saudi did this, or hey, Citi did this in England, or JP Morgan tried this in their back office, you know, it's okay, but it misses the point. You can get disruptive if somebody bypasses your entire limitations on this mindset and goes straight to, hey, what does the customer want? And this is not easy, because figuring out what the customer wants requires you to talk to a lot of them with open-ended questions and figure this out and get insights. But startups have started to figure this out, right? They lead with design. And this is where, you know, they can disrupt banks. If an industry is so well regulated that banks make money without innovating, it's going to be in trouble. I've seen this in countries, you know, you've got your spreads are mapped out. You put a lot of your money in government securities or in financing the government. You don't really need to innovate to make money. And what's dangerous here is that when the regulator wakes up, or it decides to move to more mature market standings, or it decides that disruption is good for the industry, then banks often cannot react in time, right? They can't just turn. You know, a bank is like an aircraft carrier, really powerful, full of weapons, but it takes a long time to turn. And fintechs are like F-16s, they turn on a dime. So here's also an innovation, a point where, you know, banks can get disruptive. Now, what does this mean for fintechs, right? So here's some key points for what I call the fintech playbook, right? So each one of these I can give a 90-minute presentation on. So I'm limited to 20 minutes. I'm going to quickly go through them. First of all is, guys, if you unbundle, then a really good mid-cycle strategy is to rebundle, right? So what you usually do as a fintech, you understand the customer value chain. You figure out where is the customer unhappy in all his journeys related to financial services. Then you say, hey, I can do it better. I have a fintech. That's you unbundling and giving a product. Then once you have a certain amount of install base, what you need to do is rebundle. Make your current offering a foundational offering and offer a stack on top of it, which comes from ancillary industries or has synergies with what you're currently doing. Figure it out and offer that, right? And this unbundling and rebundling is a very successful strategy if you can execute well for, like, say, a mid-cycle fintech. Secondly, I would say is compete with innovation. For that, for me, the definition for that is a ruthless obsession with the customer. So if you have to ask me what is the biggest chink in a bank's armor, it is the fact that their DevOps cycles are really, really long. They cannot respond fast enough, even if business knows what to do, right? So if a startup has super agile DevOps cycles to turn insights into features, that's a huge competitive advantage. Listen, a bank will come out with a new version with powerful features of his digital banking app, maybe in 18 months. Fintechs, you guys have to figure out how to do that in 2 weeks. And if you can, that's a really, really, really powerful advantage. And if you flip it, any bank that can bring a growth mindset to its DevOps and delivery team and similarly deliver features to an app, say in 2-3 weeks, that is the most powerful bank in the region. That is not a bank that can be beat, right? So if I had to hone into one thing, I would hone in on that. The foremost measure of success is an emotionally engaged customer. All other metrics fail compared to this. An emotionally engaged customer is up to 8 times more profitable, right? And if you look at the low attrition rates, if you look at the fact that they become advocates to you and get you more clients, they spread word of mouth in messengers where marketing can't reach, they're incredibly important, right? An emotionally engaged customer is everything. Let me give you a quick example of what we did with the fintech in Bahrain. So during the digital onboarding process, we added a small menu, right? We just simply asked, what are your passions? What causes are you interested in? We gave 5-6 examples. Let's say somebody picked unemployment, youth unemployment, right? And so in 6 months, this guy will get an email from the bank. And the email says, guess what? Here is your savings. This is how much you've made in the last 6 months. By the way, using some of your savings and from others, we were able to give 100 disenfranchised youths with disenfranchised backgrounds internship or jobs in our corporate customers. Thank you for banking with us. How does that make you feel? You know, every time I give this example, I have a chill that runs down my spine. That customer is going to love banking with you, right? And it's just a small twist. We didn't invest much, just in alliances and partnerships. We just added and played with the UX, but the success is amazing, right? And so if you can create an emotionally engaged customer, it's very, very hard to beat you. Lastly, I will say that you have to, if you become a data-driven fintech, be a data-driven fintech and partner with banks and build products for the 4 data-driven business models of the future. When you look at the age that is coming, it's defined by the new tech stack of, say, 5G, edge, cloud, and IoT, right? So this stack is going to be enable a new experience age. And we're talking about trillions at play here at each level of this stack, right? There are going to be only 4 business models for this future. I have very little time left. I'm going to quickly go through these business models. It's important for you to understand. So basically, you just need to make products. Your products that go to these business models will have a lot more success, right? So let me just show these. The 4 business models here are instant gratification. This involves providing customer service and products they've requested immediately. So early wage access providers, fintechs that give you your salary on the 27th day when you're supposed to get it on the 1st, this is a great example of that. Personalized offerings. With this model, companies get actively involved in helping customers at earlier stage of the customer journey, right? So let me give you an example. You work with a bank and identify people who are budget conscious and they're prone to churn. So you work with ecosystems such as retailers and other and you give these customers personalized deals and you give them constantly, you make it key to their life. Hell, you even give them installments instead of one-off capital expenditures. You become so essential to them, they will never switch from you and the bank, right? The third is gamification. So gamification doesn't rely on the customer to show intent. So what you have to do is you have to use gamification to change behaviors. An example of this is savings. None of us like to save. We're terrible at saving, right? So if you want stuff to become achievable, like student loans, car loans, etc., smart fintechs can come up with gamified products that help customers achieve that. And they can do that in clever and fun ways. The last business model is prescriptive. This last model allows companies to meet the needs of customers even before they've become aware of those needs. So we know of a fintech that worked with a bank on loan optimized solutions, and their product was the AI algorithm that they brought to it. This has been done, and the numbers are astonishing. The bank increased the average loan size by 15%. They reduced time to funding from 21 to 8 days. They lowered underwriting costs by 78%. They achieved an increase by a factor of 4 in monthly loan volume, right? So that was just a very smart fintech partnering with banks. So the 4 business model of the future that are all data driven are right here. If you address them directly, your chances of success are that much. So I hope I was able to give you some food for thought. I'm going to hand this over now to Rory and Tom for some UK fintech perspectives.
Thanks, Habib. Wait for Rory to share the slides. I'm ready to go. Okay. Yeah, if you go to the next slide, Rory, please. So hi, everyone. Pleasure to be with you this afternoon. My name is Tom Hoskins. I'm a partner and co-founder of Growth Builders. So was at PwC for 10 years. Last 5 years set up and grew the Scale Up program across the UK and internationally, and have since set up Growth Builders to continue to support that, but also support Scale Up corporate collaboration more broadly. Here are the sort of 4 things we do as a business, just as a quick plug to start things off. Business support, so accounting, finance, and those sort of services, but getting you access to the right people when you're hiring, a big pain point that scale-ups face all around the world. Access to customers through programs like the Scale program, which I'll come on to, and then obviously you have the co-creation for bespoke corporate programs. So next slide, Rory, please. I will speak quite quickly, so we're quite short on time. So this is a slide that basically covers the PwC Scale programs. It could be very relevant for people watching today because in the UK, we're about to go through our 4th FinTech program and applications are now open. The Scale program itself covers 10 weeks. We have B2B SaaS product ready companies that are normally at the Series A funding mark. They go through a 10-week program that covers business masterclasses from PwC experts who are working with large FinTech FS corporates on a daily basis, understanding their needs, bringing that insight back into the cohort of companies, getting corporate insights to come in directly from the corporates, as well as entrepreneurs who've been there and done that. And essentially what we're doing is readying the cohort to get ready for pitch and introductions. So there's different levels of pitching, are both on the larger and smaller stages, and that'll be getting access to the right people within the banks, and we'll touch on why that's important going in a minute. And also pitching to PwC industry relationship holders, leaders, and everyone else who you need to know in the network, and that drives sales, partnerships, joint go-to-market opportunities for fintechs and the large banks as well. Next slide, please, Rory. So we've run 40 programs in scale so far, and we've worked with 400 scale-ups. As I say, we've done 3 fintech programs, and that's engaged a lot of corporates, sort of around 300 corporate executives, driven a hell of a lot of commercial opportunities and commercial contracts that come off the back of it. What we've tried to do is gather some considerations that we see across all the programs, but these are very related to fintech as well, which Rory will cover in more detail as we go through. So particularly starting off, we have to be very wary that we're in a virtual world and the selling has become slightly different. You have to be even more focused on who you want to target, because whilst people are more available on the corporate landscape, they're actually getting more and more noise over the virtual channels. So you need to nail your ideal customer profile, your buyer personas within those businesses, particularly in a bank, which is massive. You need to make sure you're hitting the right person. Everything we get taught in predictable revenue, we now need to implement the predictable revenue, the book by Aaron Ross. And therefore you're being clear and very succinct about what you solve. So, we see fintechs come through the cohort and they're trying to hit every area of the bank when they actually can't. Just pitch what you can excel at. The market positioning you come with is key here. So making sure the messages you give are very, very relevant. So a good test of that is whether someone can actually refer what you do. So if you're having an initial conversation with somebody and they need to refer to somebody else, how simply can they do that? If it's too complicated, you need to simplify it, and you need to make sure you're pitching the right level of tech expertise to people too. So this also goes through the process of actually co-designing a potential prospect call with somebody. So one of the big bugbears we hear from large banks, corporates who are dealing with scale-ups, and this goes across wider than just FS, is that they get pitched at for an X amount of time. So let's say you've got a 30-minute meeting, 25 minutes of just sort of all tech, new products that are coming out, bells and whistles. Actually, we need to use this time to learn about what the banks are doing, more particularly in, what are they looking to achieve? It all goes back to what Mark was saying about actually they're strategically aligned. You need to find out more about what your people, what your prospects are actually needing, and take them on that journey with you. We've learned from Chris Conde, who's a very successful entrepreneur, founder of SunGard, and grew that massive, to be wary of unpaid pilots. So, and that goes as far as actually doing too many unnecessary demos as well. Your businesses are probably the most interesting thing a lot of these people within banks will see on their daily basis. They will want you to keep demoing, but actually you need to be qualifying people before you demo. If you go to a pilot stage, you need to get some sort of, if you can, try and get some sort of small paid contract in place, because that'll then start the conversations about the procurement process, etc. down the line. If you can display the benefits of your product without the need for using any sensitive data, brilliant. I mean, that's always a bit of a blocker when it comes to working with banks. Obviously, the data they have is very sensitive. That's why the procurement process is so robust. But if you can try and do it with dummy data or something else, perfect. Stakeholders and processes, there are lots of both. I think stakeholders, anywhere between 5 and 11 people you'll need to convince that your product's worthwhile to invest in as a business. And to be honest, some people do get lucky and go around this and actually streamline through, but that's very rare. So make sure you are getting to the right people, and also ask a lot of questions when you're at this stage. What are the processes, and who do you need to talk to? And then finally, in the UK, there's loads of corporate accelerators surrounding fintech. So Scale being one of the ones, and I would obviously say that's a good one because we run it. But there is also other ones that are out there also good. So when you're looking to try and join them, some are very good, but just check that it's more than just like a working space, or check whether the weighting is early stage or late stage. How big's the team delivering it? Who's actually commissioned it, spearheaded it from the corporate. So obviously what the buy-in is, and then do your homework, speak to alumni. But one of the main things I always say about accelerators is you need to put effort in to get a lot of effort out. So that's where we are at the moment. And then finally, before I pass on to Rory, This is kind of the fintech, well, this is an investment landscape in the UK, and it probably resonates with outside the UK very, very closely. The equity story is basically what VCs are looking for in terms of all the juicy good bits that you need to include in your pitch decks when you're raising finance. So I won't dive into these specifically, but from a few conversations very recently, VCs are definitely more cautious about investing at the moment. Not only because of COVID, they're being more cautious in that respect, but obviously there's been a few big sort of burns in the space when we look at the B2C fintech side specifically, with some down rounds and some frauds. I'm sure people know who they are, and as such, a lot of the investors and VCs are using these as an example on how to be wary. But so they're increasingly focused on what a scale-up USP is, and also the commercialization of the product. So you need to make sure that you've got your business model, commercialization plan completely nailed down. How are you actually going to make money out of what you do, and when as well? It doesn't need to be right now, but down the line you need to have that mapped out very clearly. The money is still flowing. Rory will touch on this in a bit more detail about specifics, but when traction is evident, obviously it's easier to get money. The data so far suggests that there hasn't been a huge hit on valuations, but I think that's more to do with the fact that the weaker companies have not been raising, and the ones who have been raising are probably having more convertibles, so therefore they're pushing the valuation discussion further down the track. So looking at some of the sort of recent deals that have come in, they have been slightly lower valuations. I think the data is probably just going to catch up as we go through, and you'll see a sort of slightly less valuations, but I think that represents sort of COVID more generally. So that is a very, very quick whirlwind of sort of a few tips and tricks, and then Rory, over to you.
Great. Thanks very much, Tom. Quick intro on myself. So I joined PwC over 4 years ago in our London office. Started out in the insurance practice, working with medium-sized technology companies. I think one of my most interesting clients was Funding Circle. That's UK Fintech unicorn back in 2016 when they were IPOing, and they've hit harder times since they floated, but probably one to watch. But yeah, I'm going to go through a few slides that we pulled from our 2019 Global Fintech Survey. We're doing the survey again this year, but we're hosting that later in the year. So using the 2019 figures for now. So we surveyed over 300 executives, half of which were from the UK, half of which were globally. So you can see here on the first slide, the reason I want to show you this slide is the importance, I guess, of those executives on the UK region. As you know, there's kind of a lot of fintech activity over here, so ranking second there and third globally. And kind of the reasons behind that, I think there's three key factors. The first one being regulation. So open banking came around after the 2008 financial crisis to try and increase competition in the market. So through open APIs, new entrants, exciting fintechs were able to create really interesting, exciting, innovative financial products for customers, and it really moved the ownership of data from the bank and put it in the customer's hand. So that's the first one, opening up of regulation. The second is investment, huge amount of investment going into fintech. Last year in the UK, we saw 4.9 billion, and that ranks second globally, only to the US. And then, yeah, as Tom mentioned, in terms of the money still is flowing. Between March and mid-August, there was 3.3 billion invested in fintech in the UK. So if you compare that to last year's figure of 4.9 for the whole year, it's pretty comparable. So yeah, it's there. The money's still flowing, and there's currently 9.5 billion of VC dry powder being waited to be deployed in the UK. And that equivalates about 1 year of runway for VCs. So the money is there, which will be supporting portfolio companies, but also new investments. And then the third key factor in the UK, I'd say, is the talent. There's a good level of homegrown talent, but also I think that investment, the hyperbrand fintech has really attracted talent from abroad. I'd say a bit of a double-edged sword in the fact that the because there is so much activity going on, there is a real fight for kind of good talent, especially on the tech side, so software engineers, etc. Just something we work a lot with our cohorts is attracting and how to retain key talent, and probably something that's slightly overlooked sometimes with our cohorts that come on is the culture. So creating the best culture that's going to want to make your employees stay for the long haul and throughout your growth journey. So moving on to some of the challenges and opportunities that came out of that survey. I'm not going to go through all of them because slightly limited on time, but one of the key challenges is around legacy systems of these large banks. And I'm sure you've heard a lot about it before. And when you're moving into a new region such as the UK, and this will be the same when you go through to other regions as well, is understanding the systems that region use. They'll be comparable across the kind of region, but also each entity will have its own specific operating model, software, etc. that they use. So it's really important to think about how your product integrates, works alongside those systems. What's the time scale of integration? How quickly does it take? And also whether you're potentially replacing certain systems or piece of software, which could potentially be a barrier. How are you moving that data across to your system? And is the current incumbent locked into a contract with their current software provider? So I think, yeah, that's the easy bit. The tricky bit is actually how do you find out that information about prospective clients that you're speaking to? I think one is leveraging your own network, speaking to people inside the organization that you'll meet. Also professional services firms such as PwC, leveraging their knowledge of the inner workings of these large corporates, also consultants such as Accenture, and I guess other vendors, other suppliers who work with those corporates. Next key challenge I want to pull out is regulation. So I think it's hugely important to be kind of aware and knowledgeable on the regulations in the region. For example, in the UK, payments, PSD2, across Europe as well, and SEPA. And then on the data side, through the Data Protection Act on GDPR. So I guess being really knowledgeable about those regulations, making sure you're compliant, making sure you've got the correct criteria, because that can be a huge downfall if you do go into the procurement process and you haven't got those in place. And then moving on to some of the opportunities, so 80% increase in investment over the next 2 years, 82% expected to increase fintech partnerships. So kind of really good sentiment there in the UK, and we expect those percentages to increase. And on the partnerships, Deutsche Bank recently announced kind of a new investment in TraxPay to enhance working capital management products for their corporate customers. And we're seeing these kind of partnerships spring up every week in the news and through our kind of work with our clients. So there's a lot of opportunity on that side. So to what extent is fintech part of current incumbent strategies? So a small percent, those first two blocks, indicating that there's no formal strategy, or there is an informal strategy, but it's not embedded. Then there's roughly 40% that have a formal strategy, but it's not embedded in their operating model. And then the remaining 40% have a formal embedded strategy. And what we're seeing at our clients is these numbers are only increasing, and they are spending more and more time formulating these strategies, some of them Mark touched on earlier. And another thing I kind of wanted to mention in terms of how do you approach the FS market when moving into the UK, because it is such a huge market. You've got the retail, commercial banking side, you've got capital markets, investment banking, you've got insurance, you've got AWMs, so asset managers, wealth managers. And how do you actually approach that? Some of you will have solutions that are applicable to the whole of FS. And I guess bringing it to life, we had a RegTech on the program last year from Europe who's using the program to kind of leverage growth in the UK. And they very much had a spray and pray approach in terms of let's speak to the whole FS market, see who's interested, try and take on as many clients as possible. But we actually sat down with them and kind of mapped out the subsectors in terms of which ones have the best client acquisition costs, the different competitive landscape within each subsector, also their current expertise, their current client base in their domestic country, and how could they leverage that moving into the UK. The needs for each market segment are hugely different, especially on the regulation side. Large banks have huge reg and compliance departments, where on the asset and wealth management side, even the larger firms don't have a complex risk and compliance function, with only about 50 to 60 people. So on that AWM sector, a single software solution that solves multiple use cases is more desirable. Where on the larger banks, they have the resource where they can actually spend money on a single use case solution, for example, that would tackle fraud in payments. So we helped that RegTech focus on that one sector. They built their expertise in that area, their marketing materials, their product development. They were able to show traction in that sector, scale up quickly, and then branch into other FS subsectors. So kind of who is responsible for digital innovation technology? You can see between the UK and globally, it's kind of quite comparable there. And I just wanted to kind of pull out the importance of reaching correct budget holder within a bank, but also making sure you've got all the different influencers, stakeholders on board. And it's something, speaking to a lot of founders, is hugely frustrating. These large corporates have so many different departments, a lot of different stakeholders. How do you navigate that to find the right person? And it's definitely a case of identifying the different influencers and their personas throughout the whole chain, from the budget holder all the way down to the end user, and kind of finding out what influences them and what they're going to be interested in about your product. So the budget holder predominantly is focused on the key ROI of your product. The tech persona will be more focused on the product and its functions. And then as you work your way down to the kind of final end user, they care about the interface, the user experience, how they're interacting with your product on a day-to-day basis. And you might have multiple personas on a sales meeting, on a call at once. So it's important to know who they are and making sure they can see the real value in your product for them. And I think touching on kind of something Tom mentioned earlier in terms of co-designing a pilot, once you've got board approval, they're going ahead with a pilot of your product. It's very important to make sure the key stakeholders are emotionally invested in that pilot. So actually going into a pilot meeting without a set structure of what the pilot will look like, you might have it in your head, but then you build it out with your client, so they're invested, they feel like they've helped design it, they've put some effort into it, and they want to see success for your pilot alongside yourselves. So definitely kind of a little tip there. So moving on to the next slide, incumbent activities to drive fintech growth. So you can see kind of a huge amount of different strategies there, and incumbents are definitely using a mixture of different strategies. We've definitely seen over in the UK corporates trying to build fintech products in-house. RBS tried to built a product called Bow a couple of years ago, and it didn't go very well, and they lost a huge amount on that. But that's not to say that we're not seeing corporates still taking that approach. Santander recently launched their fintech product, Pajo FX, which will rival TransferWise. And we're definitely seeing in our conversations with our clients that some are preferring to build in-house, where some are definitely looking to partner more and go down the strategic alliance. We're seeing a lot more activity in the CVC space. The likes of Citibank, Goldman Sachs has recently raised a 2 billion technology venture fund. And we saw, I think it was around 350 plus CVC deals last year, in which the UK ranked third. And yeah, another point I wanted to make around a conversation I had with a senior exec at a tier 1 bank last week around the strategy. And I think this links in very well with what Mark was saying in terms of making sure your solution is aligning with the corporates you're engaging with. And the conversation last week was around if a fintech solution doesn't align with the current strategy, then it's going to be tricky for them to take you on board. Therefore, you're wasting resource on that. So identifying corporates whose strategies align with your solution is key. And again, the tricky part is finding that out. So leveraging your network, speaking to consultants, asking your contacts at specific clients. And we worked with a cohort member last year to map out the current corporates in their market who were going through tech transformations or with tech transformations in the project, so they could focus their resource on those corporates. So yeah, I know resource is always a limiting constraint, especially at that earlier seed stage. So focusing on the right people at the right time is hugely important. Conscious of time, last slide on the survey, but kind of pulling out some of the greatest challenges to implementing a fintech strategy. And this is on the corporate side, but it's definitely really important to be aware of what those challenges are. And we've discussed it earlier, the legacy systems, how you're integrating with those, the regulations, what are the regulations impacting the corporate, but also what are the regulations impacting yourself, and how do those two intertwine? Also then the data, how do you use access client data? And then fourthly on that list is the fintech risks. Corporates have been burnt before after onboarding fintechs and then having data breaches, cybersecurity issues. And that is why there's such a long procurement process for a lot of these tier one larger corporates. So you're looking at kind of 1 to 2 year sales cycles on some of them, which is a long time, especially when you're at that earlier stage, as many of you will be. And we worked with a fintech last year around, they were spending all their time on tier one clients. And it's not great for your kind of recurring monthly revenue, getting in new clients, and you're putting a lot of resource into it. So we worked with them to actually make sure they were hitting the right mixture of corporate clients. Oh, seeing a message coming in. 1 minute warning. Okay, so I'm going to wrap it up quite quickly. So making sure you got the different mixture of corporate clients. So we traditionally look at a kind of 25% your larger tier one clients. And speaking to executives, if you do have a tier one client on your client list, it gives them peace of mind that you've been through a rigorous procurement process, you are up to those security standards. Then 60% of your resource and your time focus on mid-sized corporates. These are going to be easier wins than those larger corporates, but still a decent amount of revenue. And then 15% of your time on smaller clients. These are great to kind of use as guinea pigs, I guess, but kind of test out new product developments, have a more kind of interactive engagement with them. So a real mixture of all three. Then, so moving on, just wanted to touch on this very quickly, just 3 slides left, but in terms of the regulation, how PwC splits up the fintech market. And the points I wanted to make on this was competitors working in your subsector is important, really important to know when you're going to a new region, who those key competitors are. Obviously, it's a more global landscape, but you will have local competitors. How you differentiate from those competitors, and when there are unicorns in your subsector, for example, on the KYC side, you've got OnFido, how you differentiate from them, and also how are you defensible? How have you built a moat against them building out similar tech to yours and copying your ideas? So there's the same here for data, and also kind of the same points I just mentioned. And then finally on the payments as well, probably a bit more kind of complex in terms of the structure of the market and the different players and how they interact. But yeah, that was all I was going to say. It's been a pleasure talking to you. I'm going to pass over to Sameer. Thank you.
Thanks, Rory. Thanks a lot. All right, guys. So I don't have a slide presentation, but I'm going to give you a perspective from a bank's angle on how we work with fintechs and what are we looking for, right? And what's made what some of the challenges that we've faced. So let me start by saying that I was brought into GIB, which Gulf International Bank, to challenge the status quo. And, taking a quote out of what Mark said earlier on in his presentation, if you've always done it this way, it's probably wrong. And that's exactly what I was brought in to do, to challenge that and go, let's not recreate the wheel, because that's what we tend to do. Any organization tends to do that, right? They want to do that. Hey, if the fintech can do it, so can I. No, that's not your forte. That's not your strength, right? So don't try to beat them, join them. And that's the message that I've tried to bring in this past year that I've been in GIB, that let's work with them, and bring them on board. And I'm going to go through some of the KPIs that I went through. The first thing you need to do in order to work with fintechs is to have that internal buy-in, right? You need that business partner to sponsor it. You need them to buy into what they're going to get into and what are they looking for out of it, right? But it's not only the business partner. You also have to get the other stakeholders to buy in, the key stakeholders that will make it a success. So for example, if I was working with corporate banking, and I'll get into an example of that, and getting that team to come on board and go that, hey, this is a new line of business that we want to introduce and accelerate at an exponential rate, right? This is the partner that we have to work with, right? And we should be looking at it for all the right reasons. And there's a list of criteria that Tom and Rory have put out over there. And even Habib, that what are the success factors you should be looking at, right? You look at those, but then again, you also have to have the buy-in from technology that hold the back-end services for you. You need to have the buy-in from compliance. You need to have the buy-in from information security, because they can make your life they can stop things. I was going to say living hell, but they can stop things, because, and especially in this part of the world, in Saudi Arabia and Bahrain, where it is quite restrictive, regulations are pretty stringent. How do you work with these stakeholders and make sure that their needs are also met? So you need to get an overall buy-in from everyone in order to make a move with the fintech and be able to successfully implement with them. Performance and KPIs. So let's walk into that. What I would say is that whenever you work with a fintech, there are different ways you can look at it. You can look at it, by saying that, yeah, they're a tier one company, a fintech. They've done, solutions out there with other banks. And because they've been successful, they'll also be successful with me. You can look at it that way. You can look at it from an acquisition strategy and go that, hey, you know what, this is something that we want to get into, and we may look at them just to acquire them. We may first start off in a matter of, look, how would we work together or not, but the end strategy is acquisition. That's fine. Whatever it's over there, you can look at it. But the biggest ingredient that I would say is that making sure that the people that you work with, are the fintech that you bring on board are the ones that are willing to put skin into the game. So when you define what the performance metrics are or what the KPIs are, they need to have the skin in the game. And what I mean by skin in the game is, if you lose out, they should lose out. If you win, they should also win at the same time, right? And that keeps both parties true and hold them accountable, right? And that's something that I've always been focusing on with our KPI, with our fintechs that we brought in and worked with, right? So let me give you a first example. One of the ones that we introduced recently was a new MSME business in our banking. This is a completely new line of business that we've never had, and we wanted to capitalize on it, and we wanted to really accelerate on it. And if you hear about all the news that is going on with fintechs and banks that are working with SMBs, right? This was the right time to do it, right? But we wanted to really grab the market and so forth, and we wanted to make sure that the partner that we worked with was going to win with us and fail with us. And if they were going to fail, they were going to quickly fail with us and get up again and do it again and make it right. And that's exactly what we did, right? So the partner that we brought in, not only put in their time and effort, from their side, but also made sure that the application met the nuances of the bank, of the regulator, and more importantly, of the customer need, right? Which I'll get into a bit. It was focused, but the customer need played the most integral part. It addressed the why for us, right? And that was the key differentiating factor, that we were able to address what was the biggest pain points that they had. And the biggest pain point that we addressed in the MSME side was not about lending, which everybody's doing at a great rate or deferred rate, or, you know, you don't have to pay for the next 6 months and things like that. No, our MSME lending focused on giving them working capital finance based off on their invoices that were coming, and being able to provide that instantly at the POS level. You know, so that really made the differentiation. Nobody else was doing that, and this is what MSMEs were dying for. That look, during the pandemic, we were seeing a growth in business, you know, like the corner grocery store and things like that, but we aren't able to meet the demand rate in terms of getting the supplies in. So when we're going to our supplier, our distributor, to bring in the supplies, they're asking us for capital. They don't want to extend the credit anymore further than what they already have and so forth. So they need that capital immediately. And we can't get that because, you know, we still have, you know, we have agreements with our customers on how they are to work, and we can't change that. So it was filling that gap. It was finding that biggest pain point that they had and being able to service that. It wasn't anything, you know, rocket science or anything, you know, that we did, that others couldn't have done. We just found that customer pain point, that unique customer pain point, and we serviced that. So this is going into what what Habib had mentioned is, why is innovation for growth failing? Because what we tend to do, and what, you know, where the fintechs are also at times I see that they look for, is that they want to become the next unicorn, right? They want to be that next unicorn and things like that. And quite frankly, even the banks even try to look at, you know, they want to work with the unicorn. They want their product or service that they're going to offer with the fintech to be that unicorn. And that's where they fail, because they're so fixated on being that unique differentiating factor that they forget the customer needs. And I'm again and again going to go back onto that, because that is the key ingredient. We tend to forget what the customer's needs are, right? And you know, there was a comment over there also made by Habib that, you know, disruption starts with customer pain points, right? What they're demanding. It's not the technology. And that is so true, right? The technology has to work for the customer, not the other way around, right? It has to address their needs. Then you'll be able to make a success out of it. And that's what we've been trying to do at the bank. You know, we were focused for the past few years, both in our corporate and retail banking. We were focused on just, you know, bringing the best technologies, bringing the best consultants into play, and going, yes, this is the way you got to do it, because this is what data is telling you, and so forth. Absolutely, data is important, but you got to mix it with empathy. If you don't have empathy with it, you're not going to win, right? And it's understanding that. And that's sort of the thing that whenever we've stepped into the ring with a fintech player, right, we've asked them, tell us what needs have you addressed as of recent with any of the partners that you worked with, or any of the other institutions you worked with. Doesn't matter small or big or anything like that. Tell us where at an emotional level have you really engaged them, right? So speaking about being emotionally engaged, which is one of the key success factors, because if you can get them emotionally engaged, nobody's going to leave you, right? Because they make it personal. It is something very personal to them, right? And so that's something that we've been also focusing on. And the biggest thing on that one is that when we worked with, in the loyalty side, when we introduced our first loyalty program, you know, we had the same bells and whistles that we, yeah, points you learn, you'll redeem them, you earn them and whatever, and you get a marketplace and so forth. You know, the vanilla product was there, right? And we could have gone out with that and done okay, but we really wanted to go that, no, we wanted to differentiate ourselves and see that not only are we going to connect with our current customers, but we're going to come up with something that would differentiate ourselves and why come and work with us. And the biggest thing that we managed to differentiate is when we looked at the data, we saw that in the social analysis, people were upset about the cashback that we gave, right? You got your cashback, but it took 3 months before it would show up on your credit statement. Right? That was something that was annoying it. And it was supported with internal data that we had gathered through the call center or anything of that nature. And it really upset our customers. So we made sure that the loyalty program that we brought out at the POS level, you would be able to, this is working with a fintech who enabled it for us, that at the POS level, you would be able to instantly redeem, and it would give you the credit immediately. That was the instant gratification that our customers were looking at. And especially at these times, right, when everybody wants that, right, we were trying to deliver on that. Last but not least, what you want to also do is that when you work with a fintech, you want to be able to ensure that they are flexible and adaptable to the ever-changing needs of the current market and of the current demands, especially in this pandemic time that we're living in, right? What happened? People, yeah, they were going out, eating out, restaurants and things like that. That was where travel was the biggest growth that we saw in card spend and so forth. All of a sudden, that went out of the window, and people were only sitting at home ordering, you know, takeouts and things like that, streaming, iTunes, Amazon, all of this, you know, e-commerce channels were there. And we were able to work with the fintech to quickly adopt the whole marketplace, the merchant offerings, to focus on that where the growth was. And that's what catered to the customers. That's what they love. So overall, what I'd like to say, as I've only got a minute left, is to say, if you're going to work with a fintech, work with them who's willing to have skin in the game, that are willing to align with your KPIs and your objectives, right? And more so that they're flexible and adaptable to the customer needs, ever-changing customer needs. Thank you very much. I'll pass it over to Ali Khan from PwC.
Thank you very much, everybody. That was very enlightening for me, hopefully for the entire audience as well. I'm going to sum up the session with some stories and takeaways from what I heard from everyone else. But just one suggestion or one request for everybody in the audience, please do use the Q&A function to ask questions. And I'm going to talk to you for about 5 minutes, and then we're going to go into the Q&A session. When I reflect back on what are the things I've heard over the course of the last hour, I understand there are many different themes, and I picked out the ones that I think resonated the most with me. Mark talked about making sure that you're aligned to corporate demand, and he ended with a quote that said, "A lot of companies have innovation departments. That's a sign something is wrong." And what I'm going to do is I'm going to try to take those themes and bring them into real life examples with companies that we use every day, a little bit outside of where we are in fintech, just to understand that what are the key factors you can take from these quotes or these topics that the speakers have spoken about to really set you apart from banks, so you have a unique value proposition that banks want. So Mark talked about, you know, companies that have innovation departments, that's a sign that something is wrong. So we'll talk about innovation. Another piece was Habib and Sameer talked about even the disruptors getting disrupted. Habib talked about the importance of leadership. Sameer talked about being flexible and adaptable. And I'll share a little story with you on that as well. And lastly, Tom and Rory talked about, you know, can you co-design a solution? And if you can, you need internal buy-in. And so when I look at these topics, it brings to mind some key factors that will really help you set yourself apart from banks. And those factors, I think there are about 3. The first is to make sure that your firm has an entrepreneurial mindset. And I'll give you an example of what I mean. And I know these examples are cliched, or they may be cliched, but I'm telling you this, some are from personal experience. In the late 90s, I used to work for Amazon. And I'll tell you, in 98, 100% of Amazon's sales came from an internal retail model. Amazon would buy the goods, put it in a warehouse, and sell it. And each and every category, so whether that's baby, whether that's entertainment, etc., like a Procter & Gamble, like a Unilever, would have its own head. But to what Mark said, that anyone who has an innovation department, something's wrong with you. Amazon internally decided to borrow A, from what Mark said, and B, what from Habib said. They said, we're going to disrupt ourselves. And what they did was they created this concept of third-party sellers. And today, 60% of Amazon sales come from third-party sellers. So don't be afraid to disrupt your own business model. And what they've done is they've made their own internal category leaders as entrepreneurs. So they have to compete against those third-party sellers. So don't be afraid to put up your staff against a bank and say, go head on. you never know where that collaboration will take place. And the lesson that we want to leave with this is that's how you build a business, right? Often what companies start doing, having our own retail environment, the final version is very different. And now they're completely dependent on this ecosystem of third-party sellers or materially dependent. The other one I want to talk about is what Habib was saying. He said even the disruptors get disrupted. And then Sameer, when he came in and he said, look, you've got to be flexible, you've got to be adaptable. Not sure how many people are old enough to know this or appreciate this, but back in the day, there used to be something called the Encyclopedia Britannica. And these were essentially 26 books, one for each letter of the alphabet. Everything you needed to know was in those books. And in 1990, believe it or not, those books had $650 million in annual revenue at that time. It's probably worth about $3-4 billion in today's dollars. And they sold about 120,000 units. Fast forward a couple of years, Microsoft entered this market. And for those who are not as old, but a little bit younger, they'll remember that Microsoft came out with a CD called the Encarta CD. And they competed on price, accessibility, and speed of update. And I say that for a reason with fintechs. Remember, price, accessibility, and speed of update. It's not something that everyone can do. It's something you can do. So Microsoft came up with the CD. Britannica sales dropped to 50,000 units. Microsoft sold over 1 million units. And 5 years later, Britannica, those books, they sold the entire company for $130 million. And 5 years ago, their revenue was 650. So just imagine that fall. Now you're thinking, oh, that's a historical story. Okay, fine, Microsoft disrupted. But this is what Habib was saying. Even the disruptors get disrupted, right? 5 years later, 2001, Wikipedia launches, which we all use today. Again, Wikipedia competed on accessibility. They're via the internet everywhere. Price, free, speed of updates, immediate. And I remember there was a quote that came out back in the day when they were trying to pitch this to Steve Ballmer because it's an open source, it's works on donations. Steve Ballmer laughed them out of the room. 10 years later, the disruptor got disrupted. Microsoft used to make $300 million from their CDs on the Encarta, and Wikipedia survived. So I don't want any fintech to think, well, we're looking to pivot like Amazon did, but we can't enter that market because so-and-so is already there. Remember, there's always room for improvement. Even a disruptor is not immune to disruption. And that was a key point that Sameer was talking about and Habib was talking about. Now, Tom and Rory talked about co-designing a solution. They talked about internal buy-in. And I know I've gone ahead in time, so I just want to talk about this recent movie that came out almost about 6 months ago, Ford versus Ferrari. For those who've seen it, I want to bring it to light to you to reflect upon what Tom was talking about, what Rory was talking about. Can you co-design? Can you get internal buy-in? So for those who haven't seen the movie, I'm not gonna spoiler alert, you might want to put me on mute, but Henry Ford in 1963, he met with Enzo Ferrari and he said, I want to buy your company because I want to diversify my product range. I want to be more hip. And Enzo Ferrari did what most banks do with you, right? So they'll listen to the concept and they'll say, we can do this ourselves. So what Enzo did is he went to Fiat and he leveraged Ford's proposal and he secured a deal with Fiat. How many times have you seen that? You've gone to a bank, you've given them a proposal, they go back thinking we can do this ourselves. So then what Ford did was he said, look, man, I'm going to go on a mission. I'm going to beat Ferrari at the Le Mans race. And that was seemingly impossible, right? How can a Ford, a family car, beat a well-designed sports car? And so this is what Ford did. And this is what I want to tell all the fintechs that are there. And this is what Tom and Rory were referring to when they said, can you co-design? Can you get internal buy-in? They essentially set up a company, so to speak, named after one of the engineers, Shelby. And that company had mechanics, like literally, if your car breaks down, the garage you go to across the street, that kind of mechanics, they had drivers, and combined with Ford's engineers and designers. It's something no one thought of doing. And because they got down in the trenches and they understood what it was like and they worked with the people in the trenches, is something banks cannot do, but you can. And what happened was, 5 years later, the Ford Shelby partnership won the Le Mans for the first time, and their cars came first, second, and third. Ferrari nowhere to be seen. So the key lesson here is, look, don't be hesitant to collaborate with the unconventional, because you can go to the front line and you can understand what are the problems, what are the challenges. You can get customers to come in and give you feedback. With banks, there's a whole bunch of issues, right? There's security, there is data violations, there is do we use the right vendors to get the right focus groups, etc. So the lesson being, what Rory and Tom were referring to is, can you co-design a solution? And who are the best people to co-design with? The people who are in the trenches. So those are the couple of key messages that I got from what they were talking about. Just want to quickly jump onto questions that we see. And there is a question here from Niall saying, can anyone shed light on how you might progress within the technology or data science area when you're bringing automation that may scare them or reduce headcount? I understand, Niall, this is a key problem that a lot of people have, and I see Mark smiling, so I'm going to hand over to Mark to see if he wants to address this, and then pass it over to some of the other participants.
I suppose, thanks, AK. I think it's inevitable, right? And then I think it goes back to the question of, are you speaking to the right sponsor, the right level of sponsorship? And actually, we've seen a shift recently in the banks whereby they're not remunerated based on the number of people that they employ, or the prestige is not associated with the number of people that you employ, but rather the amount of output or outcomes you're able to deliver as the head of a particular function. So I think if you move up the hierarchy and you speak to the right individuals, I think people will overcome that fear. Not saying that it's great that people are released through the use of new technology, but if you're able to reskill, repurpose those individuals, give them perhaps a role that's more fulfilling than something that can be replaced by a robot, then I think that's probably a positive for everyone.
No, thanks, Mark. Really appreciate that. Does anyone want to add on to it to talk about?
I'll quickly say something. Listen, the number one way to do objection handling for automation and job fairs is to simply say and then prove with use cases and actual case studies in the world that nobody's going to get laid off. What you just have is more precious time to devote on more value-added activities. So on the whole, you will simply become more productive, right? And then just give examples, and then you'll be able to take it from there. So from the time I've been doing managed services to the time that I've branded 3 AI companies, the objection handling is the same. Take the conversation to additional productivity for their most valuable resources, and the fact that the grunt work is being taken away. That's it.
Yeah. Niall, to be fair, one of the things I say, and that's linked into what Habib is saying, is I tell them that, look, you may not keep the same people, but you can use the same headcount and put them in frontline sales roles, and you will earn more. And because the back end is all automated now, you don't need to hire more people to handle the additional volume. But before we move on, Tom, Rory, Sameer, do you want to add on to that?
I mean, I think for me, it's about how you position it. So a lot of what's been said before is correct. I think you kind of want to chunk it down a bit. So if you're trying to sell this big scary dream where you're automating the whole process end to end, you might want to start a little bit smaller and sort of get a foot in the door and start creeping it open as you go. I think people, as soon as they see the benefits in action, they realize pretty quickly that it's more of a complementary thing that you can use rather than just a complete and a like cold replacement switch in and out. So we see that quite a bit.
Oh, no, cool. Thanks a lot. Sameer, I think there's a question here that's for you as our banking representative. Mirhan is asking, what's the procurement process to launch a RFP after having a successful pilot? And how long does it take? How can it be fast-tracked? How's that experience been with you at GIB?
Horrible. No, well, well, procurement, also being in the traditional process, it takes forever, and it is like this in many organizations. The one lesson I learned in order to expedite it is to have them involved right from the beginning. So let them be part of the successful pilot. Let them be part when you've been discussing with that fintech or the fintechs, on a pilot model and how to get them, so that they are already aware of what we're trying to solve. What are our objectives, right? And also being part of even the forecasting, even if that is part of the thing, part of the process, so that they can cover all of these, or they have answer to all of these questions that they may have during the procurement process, and be able to just focus on, let's get them on board. We just need to negotiate on the final commercial numbers, and that's it. So my one advice would be to get them involved right from the beginning. And yes, they are one of the key stakeholders that you should have.
Maybe, Sameer, there's an opportunity for somebody to open up a fintech to disrupt the procurement process.
Oh, trust me, I've been asking for that. If somebody does that, please reach out to me.
Well, so there's another question from Biju, and this may be best addressed to Habib or to Rory if he wants to take it from a UK perspective. But there's a fintech that already operates outside the UAE or outside a home market or the UK. What's the best way of launching it within the UAE or within the UK?
Yeah, I think picking this up, one thing when launching into the UK, but probably a lot of parallels in terms of launching into any region, is having a sales representative on the ground over there. Having said that, in light of Corona, that's kind of a level playing field at the moment. And it's obviously probably put a good time for a lot of companies who are based in the UK and Europe to actually look over to the US, and they don't need to send someone out there or have employees based over there. So in terms of kind of expanding to the US cheaply and getting a good kind of global reach, that's definitely a positive of the current world we're living in. But yeah, we speak to a lot of founders who are branching into the UK or on the other way, branching out to the US, Europe, even China sometimes, and definitely having a team out there on the ground that's immersed kind of with the local regulators, the local ecosystem, and speaking to all the different players that they're engaging with is definitely recommended.
I'll just quickly add to that. So there's something what we call a channel play. So in a channel play, what you do is you find companies who have embedded install base in a category where your fintech product is. And then you partner with them and you say, listen, you guys represent us in your region, and then we will, we'll help you with the pre-sales and all that. And then, you can manage. So in a very quick way, I mean, so because I build pitch decks, right, for a living. So one of the way we show quick growth is a hub and spoke model. So what Rory said was great, that there will be markets where you will need boots on the ground, but you can cover the entire world very quickly with a channel play where you assign people who have an install base where your product will sell. They have the relationships, they sell for you, they take their margin, and you operate a bit from the back. That's a very quick way to enter a market.
I think
Habib, thanks. I think that's really good. Yeah, Mark, please.
Okay, so I was going to add, and Sameer can comment on this as well, but there are kind of, we talked about corporate incubation, but Visa runs an incubation program in the UAE where they support fintechs locally. And then there is a process through which you engage with banks to get BIN sponsorship, whereby you basically ride on the regulatory licensing that a particular bank has. And Visa incubates and supports you in that exercise. So that is one part. I don't know, Sameer, if you want to comment on. I know you used to support that program in your previous life.
No, absolutely. You said it completely right. It's called the Visa Fast Track Program, and that's exactly the purpose of it, is to enable you to get to the goal much sooner than later. Of course, Visa is more aligned to the payment side, but I mean, that's where, if you're working in the payment space, you could work with the Visa Acceleration Program. They tend to incubate about 20 or accelerate about 20 companies within the Middle East every year. and it's right now in its 4th year or 5th year. So highly recommend that. Yeah.
Well, building on that, Sameer, Suleiman wants to know that there are many regulatory and compliance hurdles when they want to go to market. And from your experience with Visa and then your recent experience in dealing with fintechs, what's the best way for them to mitigate regulatory and compliance hurdles to get to market in a short time? And I understand that some governments have a sandbox, for example. You have to go through that sandbox and graduate from it in order to offer your services. Is there anything else that you've seen in the region outside of the sandbox concept?
Well, I mean, you know, some of the legwork when you're part of these type of fast track programs, whether it's from Visa or even MasterCard has it and others offer it, what they do is that they take care from a payments perspective or any roadblocks that they would face on that for new payment technologies or new ways to service the client. You know, Visa, MasterCard will take care of that, right? So they do a pretty good job with the regulator on that side. So it saves you when you're trying to come in and pitch your idea from a payment angle or anything of that nature. They'll guide you, or they'll use one of the things that they've already cleared and kind of position your product and service in a manner that has already been cleared with the regulator, right? So that gives you that advantage. In Saudi Arabia, yeah, absolutely. You have to go through the sandbox program with them, graduate from that, and then be able to service the market. But what they did right now, especially during the pandemic time, if you had a solution that could address the needs to service them now, you know, during this pandemic, you know, with the lockdown and all of that, right? They graduated you know, they would immediately graduate you, you know, or expedite that process for you. In fact, I saw some of the fintechs that were waiting, all of a sudden in 24 hours, they had the license to go out and service the market. And that was just because of the fact that they repositioned the product and said that, look, this is how we can help out during this crisis time. And so I would say is that, you know, be flexible, you know, when you're looking at what your product is about and being able to adapt to the ever-changing customer needs. The regulator is also looking at that because that's the whole purpose, is to service the citizens and the residents. And if you can change that and position your product accordingly, you can actually get through those hurdles much sooner than later.
Thanks, Sameer. You know, that's linked into another question from Poonam, and I think this is better targeted towards Tom and Rory. Poonam would like to know more about, and forgive me if I'm butchering the pronunciation of this, I can say Penelope, but I can't say this, SEPA, SEPA, local regulations and other challenges in the UK as a startup. Rory and Tom, can you shed some light on that?
Rory, do you want it? Do you know more than me probably about this?
No,
to be honest with you?
I can pick that up, Tom. So firstly, I'd say that's probably kind of a couple of weeks worth of sessions in there. The regulations are very kind of crowded, quite complex, but the regulators are working to make them easier to understand, so that fintechs can get quicker to the market. I think linking back to what Mark and Sameer were saying in terms of can you leverage any partners, whether it's a bank, who are already compliant with regulations when moving into a new region. But yeah, and then I guess there's a lot of resource online nowadays that's free, but then also kind of speaking to the relevant your relevant network in those areas, whether it's in the UK or elsewhere, to kind of help you navigate those regulations.
Okay. Thanks a lot, Rory. Mark, Cynthia wants to know, what can protect somebody against a bank taking the idea and doing it themselves, especially when a pilot has been shared? Because there's always the NDA that gets signed. Fintechs generally don't have the financial resources to go through a legal battle. And is it a matter of trust? Is it a matter of relationship? Is it the collaboration piece that we talked about? How does the audience protect themselves against an unscrupulous bank?
Yeah, that's a great question, right? And I don't think it comes, I think, down to at the end the type of partner that you're actually selecting, and maybe the types of behaviors that they might undertake. And I think, you know, if you do that once, you do it twice in the market, I think the market will probably start to hear about it. So there was a question or a point made by Rory and Tom earlier around, do your research, understand what a particular bank is like, how they operate. Have they got a track record of actually, not going through and fulfilling their obligations when it comes to a particular partnership? And I think that's one side of it. The other side of it is I think banks quite often say they will try, and I think they quite often will fail. To replicate, they might steal something, which I think is obviously downright wrong. But I think that if they do it a few times, they'll very quickly be known about in the market. So hopefully that doesn't happen too often.
And you could see Sameer shaking his head, so you know that he would never do something like that. So please do reach out to GIB. But a shameless plug here. If there are any challenges in that respect, how do we enter the UAE? How do we enter the UK? We're not really sure if we can trust a bank with this. A shameless plug, please reach out to Mark and myself. We'd be happy to partner on behalf of PwC, do it, maybe even JV, and take this to market together. And then you can be sure that you do have a strong partner with you on this. Habib,
just a quick,
please.
Sorry, I just wanted to address this because, I've worked with people who've been in this situation. One of the things that works is that the bank is not at fault. There is a particular individual at the bank who is at fault. And usually he needs to shine, which is where the whole idea stealing happens. So, and any classic corporate situation, what you do is you escalate it to his leadership, right? And hopefully 80% of the time that will solve the issue. You might not get the deal, but it will solve the issue.
Yeah, no, you're right. And to be fair to everybody, look, banks are built on trust, right? Fintechs are disrupting that because the new age millennial doesn't have too much of that worry. But back in the day, it's a new concept, right? Can you trust me to give me the money when I need? Can I go to an ATM machine and take out cash? If I write a check, will it be deposited or cashed? Banks are built on trust, and this is the barometer of trust. So generally this won't happen. And if you do, Habib is right. But Habib, there's an anonymous attendee and who wants to talk about his business model. And he said, look, I entered the market in a B2B way, and it was a traditional fee-based approach. And his view was that, look, this journey is going to be too long. I'm not going to do, too well. I'm just going to get 15% market share, which may be healthy in some areas. But he's debating, quote unquote, a radically different strategy, which means giving away his product for free with the aim of getting market share, but no revenue model. And his longer term play is he'll get some data and he'll monetize that. He wanted to get your thoughts as you being a strategic investor and also being on national incubation boards on what do you think of this as a strategy?
Oh, so many things to say. Listen, there was a time not too long ago where I was building pitch decks myself, where we were focusing on the growth as opposed to, no real revenue, right? And I'm still doing that in a few cases, but I would like to think that the VC as a community have kind of turned that corner, right? So just remember one thing, they did a study, and fast growing companies that were not profitable were worth 3 times as much as companies that were profitable but not growing fast, right? So there is something to be said for storytelling that's built around growth, right? But it's under severe stress after the Uber debacle, after the SoftBank debacle and all that. So it's going to be a hard sell in many ways. And another hard sell is monetizing data, right? Because I've sliced and diced data monetization models left, right, and center. It's very, very hard to do, right? So yes, valuable data in the world, it's not scalable because you might have it for say 60,000 customers. You don't have it for 200 million customers in a country. If you have third-party data, it's not clean. So it's very hard to actually monetize data, right? So yes, if you have a compelling argument that shows the monetization of data, then go ahead and have a growth-oriented thing. There will be some VCs who listen to that, but based on my personal experience, it's so hard to monetize data, right? That I would be very skeptical of this, right? And I think that you've missed the boat by a couple of years on having an easier ride on raising money just based on a growth model. So it can be done, but a deeper discussion on where to go from here is certainly in order.
Okay, no, thanks. Does anybody want to add to that revenue model debate? Because it's a classic debate, and I'm sure there are differing opinions.
I think Habib was spot on. Go, Tom.
Yeah, no, largely agree with him. I mean, I think VCs are definitely becoming more and more focused on traction rather than sort of, and if you're talking about really early stage companies, angels may well take a punt on something that obviously has no revenue because it's pre-revenue, but to get enough money to sustain and grow it without a crystal clear, at least a plan of how you're going to monetize something down the line, I think VCs probably would be reluctant based on other things that are out there at the moment. It'd have to be pretty groundbreaking as a solution. So yeah, Habib nailed it.
Oh, no, cool. Look, there were some questions on how enforceable is an NDA in Dubai. I'm going to pass on that just because I don't think that the forum can qualify as having legal expertise. And so please don't think we're being rude. I just think that that's a very dangerous question to answer in a public forum. Privately, I think opinions can be shared. There's another question from Suleiman. Suleiman, I don't think we have the answer to this. I think Google might be the best one, but maybe Sameer knows as an ex-employee of Visa on when the Visa incubation or accelerator process takes place in a calendar year.
Well, it's throughout the year. I mean, we work with the Dubai FinTech Hive. That's one of our participants here in the SEMEA region, and so it's during their cycle we align with it. I believe it's during the summer, just before the summer months is when we are interviewing and we're looking at the different participants and so forth, and then we decide upon who's the right not we anymore, not me anymore, but what Visa decides on that who they would like to accelerate or incubate. Yeah, I mean, it's that's generally the cycle they would do. But right now with the pandemic, I have no idea right now. I could find out and get you that answer.
No, thanks. So it seems like the questions have dried up, but I have a question that I want to ask everyone here. And I know Habib already has the answer, and this question came from an article Habib wrote about 2 months ago, where he said, if I were to start a fintech today, these are the 9 fintechs I would start. So I'm just going to open this question up to everybody, is if in your home market, and you can define home market however you want to define it. I think for Mark, it's going to be a bit difficult. He lives in the UAE, born and raised in Bahrain, from the UK, part Greek. So your advantage is pick any market that you want. But if you're in your home market, if you were to start a fintech today, what would you start? Why? And is there a reason you haven't done it yet? And I know that's a tough question. You can pass on it. Or we can start with Habib, who wrote the article, unless there are other volunteers who want to jump in.
This is really scary because I have really short-term memory. I don't even remember that article much, but I'll say this very quickly.
It was in the Daily Times.
Yeah. It actually made it to the Google feed organically. It was great. Listen, so there's a very important point here, right? That people need to understand. Every fintech and every bank talks about how can I get the most valuable customer. I think one of the questions we need to ask is how do we create more and new valuable customers, right? And I feel that if you're going to start a fintech, have a fintech that answers this question. How do I create valuable customers that do not exist right now, right? So in my country, and let me give you an example of one of my clients, what they've done. They've decided that over 100 million people in Pakistan have feature phones, right? So they cannot be financially included per se. You cannot offer them. And, so there's a lot of benefits economically and on an individual level to being financially included. So what this startup has done is it's saying, I'm not going to go for valuable customers. I'm going to turn these guys into valuable customers. So they've come up with a very simple fintech, but a powerful concept. They're going to give all of these guys smartphones on installments, right? And the credit scoring for that, once they give the smartphone the installment, the credit scoring of the smartphone behavior will also allow them to give them lending, right? Simple concept, but guess what? They're not taking anybody's customers. They're creating maybe 80 million new customers. So when you ask yourself this question, do ask yourself, am I trying to steal somebody's valuable customers? Because that's a limited sum game. But can I create valuable customers from scratch?
Now, Habib, I think that's very insightful. Mark, it seems like you want to chime in.
Okay, I've got a little plug here. So I think what's been really interesting over these last kind of 6 months is two things. For those of us that have been fortunate enough to kind of retain our jobs and continue, I think we've been able to save more. But I think at the same time in this particular market, there's a very limited number of options around how do you save and actually make those savings rewarding. How do you get something back from your savings? As you know, interest rate environments remain really low. And so we're working at the moment with a particular client that's going to launch a robo-advisory solution that is mobile. So it's a mobile application and the full service is digital. So that's something I think really low cost, really easy and attainable. The minimum investment amount is going to be extremely low and the fees are going to be very, very competitive for this market. So for me, that's one that I'm fortunate enough to actually be working on. And I think there's a really interesting opportunity in this market and something I expect the whole of the Middle East to start doing more of, because to date, there's very few organizations that have tapped into that unserved part of the market.
Oh, it's very good, very good. Tom, Rory, Sameer, any ideas from your side? Not that if you want to reveal them, that's perfectly okay.
I'll jump in. Kind of similar to Mark on the wealth management side, it's traditionally been a sector that's only been open to high net worth individuals who have a lot of money in the bank. And we've seen some really interesting, exciting, innovative fintechs come through. So in the UK, you've got Nutmeg, Money Farm, Free Trade, slightly smaller, who are lowering the kind of barriers to entry for those kind of lower net worth individuals. So as Mark said, putting their savings to work and actually being financial rewarding. So kind of those startups which are improving the financial well-being of society, as it were. And then, as Mark mentioned, it's then feeding through now into the corporate space. So you've got B2B robo-advisors coming through who are helping these corporates actually serve kind of a broader range of the market. It's only going to improve the financial well-being of society as a whole. So fully supportive of that.
Yeah, I think, Rory, I like what you said. I'm going to jump in here and add my 2 cents. Look, where I throw money at when people come and they say, hey, look, we've got this idea, do you want to invest? And fintech or any startup, it's the model for me has to be very clearly B2B to C. You have to be selling to another company that sells to its consumers. It's gotten too overcrowded to sell to consumers directly. The cost of acquisition is too high. Customer lifetime value is too low. Your margins aren't as great. It's got to be B2B to C. And that's, for me, that's one of the first the first filters that I use. But over to Tom and Sameer if they want to chime in with any thoughts on setting up a fintech business in your home market.
Sure. So, I mean, probably the most exciting company I've come across recently in fintech is all around using the open banking rules that have come into the UK. I mean, they've been around for a little while now, but actually they're going to only increasingly be enforced. I know that they were being circumvented somewhat in the early days, so it wasn't actually as easy as it should have been, but now it really is. And payments in particular has been a really hot topic using that data. So any company that can essentially pass on the benefits, taking away fees that the banks charge for seemingly no reason, they pass it on to the consumer. So when you sort of go and pay with whatever card you use, actually there's a really quicker and less expensive way to do that, and that's the most interesting thing I've seen to date.
That's true, and payments is such a growing field. On my news feed, for some reason, Afterpay shows up every day. Today, they've expanded into Canada. They've expanded somewhere else. It's insane how much payments has grown. But Sameer, I see a smile on your face, and I know that's from your visa experience. But if you were to start a fintech today in the region that you're in, and I assume you're in Bahrain, what would you do and why?
Well, I think I would go to my prior. I mean, right now the region I service is Bahrain and Saudi Arabia and UAE. But if I had to step back here during my visa days, if I had to start something, I would start it down in Africa, down in East Africa, Pan Africa, especially now. You know, just to you know, in the times that we're living in, being able to, you know, provide that financial literacy, but also that inclusion. And what I mean by that is just making things easier for them. You know, one of the things that we did, it is now public information, so I can share that. Was a project that me and a couple of other guys, we started at Visa, and it was a fintech. We started as like a fintech within Visa, and what we did is we tried to make something easier for them by solving the Chama Pesa, which is something in India and in the subcontinent is called as the chit fund, where people, it's community lending, community saving, kiddie fund in Southeast Asia, and digitalizing that and just making it easier, you know, and working within the capabilities that the customers had. And so we worked with a partner, a separate partner from Visa, brought them in to help facilitate that, and using not just smartphones, but even featured phones. And that led to, you know, not only giving you that morally happiness that, you know, I'm doing something ethically right and things like that, but it was solving a niche that nobody actually looks at, right? We've all been talking about the mass affluent or the upper wealth and the high net worth and things like that, but there's a massive serving for this whole market, which is what the majority of the world is. And if you can solve something like that at that level, I think you got a big win. And I would rather bet my money over there than on the ultra wealth, you know? So yeah, that's my 2 cents.
Yeah, that's true. That's true. I think Anushka raised a comment, and she has a question as well. But the comment's quite pertinent. She believes that the Islamic finance space is underpenetrated, and especially on remittances. Now, maybe my Islamic finance knowledge isn't too strong, but I need to understand the underlying structure behind an Islamic finance remittance. But I do think that Islamic finance in itself is definitely an underplayed space, especially in this region, and maybe even with the growing population in the UK and the US. But Habib, there's a question that I think is best directed towards you, which is, we spoke earlier that, you know, the bank may steal your idea, but what if it's the investor who steals your idea, kind of shooting himself in his own foot? But what if he pays a certain amount, gets in, steals the idea, and gives it to I think a better team that executes better? How do you combat that? Have you ever seen anything to that degree?
Listen, just like you do a deep dive before you marry somebody, you need to do a deep dive on whoever you get in bed with in terms of, you know, in the VC space. I mean, beyond that, you know, I'll say, you know, just take your, you know, just roll with it, right? So curation is very critical. Not all VCs are equal. And this applies for a lot of things, because, you know, not enough people look at term sheets. And one of the things I tell startups is that you need to have recourse to a lawyer, right? To understand your options and some clauses. And a lot of VCs I've seen can, not a lot, but some can manipulate the clauses. And I know of this one startup which actually lost their company because they did not read the term sheet, you know, cleverly and smartly enough. And of course, the VC wasn't, because you have to bet on the passion of the founder. The best VCs know that a startup will pivot. So they bet on the team and the passion of the founder. So that startup eventually tanked. But yeah, just do very good investigations. I just want to say a quick thing about the Islamic finance thing. I was lucky enough to learn a bit of Islamic finance from probably one of the best guys in the business, Ashar Nazim. If you're from Bahrain, Mark, you'll know him. So, so yes, it is underrepresented. It's probably the fastest growing segment, Islamic banking and global banking anyways, and all that. But I would also say, look at Sharia compliant crypto. There's certainly opportunities there, right? And you know, and this also goes to another earlier statement that people had on regulation and regulators, because that's what your biggest friction will be. One of the things is talk to the regulators, you know. So one of our clients, which was Aeon Digital, they offer digital onboarding across GCC. but they weren't able to do that. They actually talked to 2 or 3 regulators, and one by one, and they brought this coalition of willing regulators, and they were able to then do that. So it's very hard to talk to central bankers. They are very powerful and they know it, but they do listen, and increasingly they're listening a bit more. So yeah, learn to talk to them. It's going to be a very critical part of becoming a successful fintech. If you look at surveys done on fintech from 2015 to now, regulation is always 1 or 2 in the biggest friction, right? So learn to talk to them. They listen, and yeah, Sharia compliant crypto.
I'm sure we're going to see on Binance Habib coin pretty soon. And everyone, please jump in and invest. I will be the first buyer. But look, I was just told we've run out of time 22 minutes ago. My sincere apologies. I think I kind of got a little bit overexcited hearing everybody's ideas. It's my fault. I want to thank everybody on the call. I want to thank the DIFC FinTech Hive especially. Without them, this wouldn't have happened. On behalf of all the participants, we really enjoyed this. Thank you, Mark. Thank you, Tom. Thank you, Sameer. Thank you, Rory. Thank you, Habib. And we look forward to speaking to everybody again pretty soon. And my apologies if there were any questions that didn't get asked, but through the DIFC FinTech Hive, you can reach out to each one of us if you have anything in particular that needs to be addressed. All right. Thank you very much, everybody. Have a wonderful evening.
Thank you very much.